Hello and welcome to today's webcast, Cash Flow Strategies for Property Owners. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I am pleased to introduce our speakers today, Kyle Sund and Jarrid McAuliff. Both are senior managers with our Tangible Asset Incentive Services. And with that, I will hand it over to Kyle.
Yeah, thanks, Dustin, for the introduction. Welcome, everyone, to this webcast. We hope it's going to give you some great cash flow strategies that you can apply to your business if it owns real estate and other fixed assets. So here's the agenda today. There's 6 kind of main items that we're going to talk about from a cash flow perspective, starting with cost segregation studies, and then we're going to move on to qualified improvement property, a pre and post CARES Act, which obviously was the most recent stimulus bill that was passed by Congress, or at least the kind of the largest one. And then next we're going to move on to a couple energy efficient incentives. And then after that, we'll move into kind of more fixed asset related items, such as the tangible property regulations and fixed asset studies. And then also kind of circling back with the CARES Act, we're going to talk about the net operating loss carryback opportunity that came into effect because of the CARES Act. And then lastly, we're going to have a couple of slides about just procedural rules for, really reaping the benefits of a lot of these cash flow strategies, if you own real estate or fixed assets. And first, we're actually going to start with a polling question, which I think, Dustin, you're going to take on.
Yeah. So our first polling question for the day is, has your company had a cost segregation study completed for 1 or more properties in the past? And the options are A, yes for all properties, B, yes but only for a few properties, C, no, and D, what's a cost segregation study? I'll give everyone a few minutes to respond. To participate, please click the button next to the answer you choose and hit submit. And as a quick reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of our polling questions. All right. Looks like got about 80% of everybody that's answering the questions so far. A couple more seconds here, and then I'll pass it back to you, Kyle.
Okay.
All right.
Well, yeah, it looks like kind of across the spectrum here with cost segregation studies. So a few of you have answered, yes for all properties, and then a couple more have said yes for only for a few properties, and then the largest portion was actually no, and then there's a portion of you that said what's a cost segregation study. So hopefully these slides really will be pertinent to to kind of your own business, and that you can utilize some of what we discuss in kind of the own operations of your business. So as you can guess, the first strategy we're going to talk about is cost segregation. So cost segregation studies are used to identify assets in a building that might qualify for shorter tax depreciation lives. They identify property that can be depreciated over 5, 7, and 15 years rather than the standard 27.5 years for residential rental property and 39 years for non-residential real property. So the 5 and 7 year property would be typically Section 1245 personal property, whereas the 15-year life would be for exterior land improvements like parking lots, landscaping, and sidewalks, so on and so forth. 27.5-year residential rental property, pretty self-explanatory. That would include multifamily properties, and then most types of senior housing, so independent living, assisted living, and memory care. And then 39-year property, of course, is the non-residential piece of that, and that would just include all other commercial property. So cost seg studies can be done not only for acquisitions and newly constructed buildings, but they're also great for tenant improvement projects, remodels, and expansions. And the way to think about cost segregation is this. So assume you have $100,000 of assets potentially eligible for shorter lives. The question is, would you rather take the majority of the $100,000 deduction in the first few years of ownership, or would you rather take the $100,000 deduction spread out over 27.5 or 39 years? And assuming taxpayers can utilize those deductions due to the cost seg study are worth more today than they are in the future, and that's just simply because of the time value of money. So as I mentioned, there's quite a few types of cost segregation studies. So basically any acquired properties, and then plus, all types of construction projects. So ground up new construction, remodels, expansions, tenant improvements. Any of those can make sense to have a cost seg study completed. And then if a property was acquired through a 1031 exchange, a study might be beneficial if the new depreciable basis is high enough to justify having a study completed. So these studies can be completed on a look-back basis through an automatic accounting method change, or Form 3115. And basically what a 3115 is a taxpayer would catch up the depreciation that they missed on prior tax returns by taking those deductions in the year that the Form 3115 is filed. So you're just catching up all that depreciation into the current time period. And the benefit of doing this is this can be done without amending any prior tax returns. So why do taxpayers want this done? Simply put, it's increased cash flow. It allows taxpayers to recapture depreciation deductions sooner, which of course can then be reinvested elsewhere. Or if a taxpayer is in a loss position, but they're expected to be taxable soon. So for instance, maybe they had expiring credits or they've used up carry forward losses, it might make sense to have a study completed. And really it also depends on what the taxpayer's current and future goals are. So typically for ground up new construction projects or acquired properties, a good low end threshold is about $1 million to make a cost seg study pencil out. And then for interior improvements, we typically say a low end threshold is probably closer to around $250,000. Anything above that is certainly going to make sense to have a study completed. And because of the time value of money and depreciation recapture, taxpayers who hold onto the property for more than 5 years would benefit more than if they only held the property for, say 2 or 3 years, although that can vary by taxpayer. So the purpose of this chart is to show the typical reclassification percentages by various industry types. For instance, for a $1 million assisted living facility, there could be anywhere from 20% to 35% of the property allocated to shorter depreciable lives, meaning $200,000 to $350,000 of accelerated depreciation. So take a look at a chart to find the industries that your company is a part of. The other thing to keep in mind here is that the percentages largely depend on the type of interior finishes and the quality of those finishes, as well as the business being conducted in the building and or the mix of tenants that are occupying the tenant spaces. And it also may depend on how large the site is and how many land improvements there are. So hopefully this gives you a general idea of the reclassification ranges for cost segregation studies. So this graph really, what it does is it shows how accelerated deductions would be taken in the first few years of ownership versus spread out over a much longer period of time. The blue line shows the accelerated deductions taken earlier on, but the later years would yield slightly less depreciation deductions when compared with regular straight line depreciation. The main key here is that you're front-loading depreciation deductions in the early years of ownership rather than waiting for those same deductions over a much longer period of time. All right, so let's go through a quick example. Let's assume an office building was acquired in October of 2019, and it had a total depreciable basis of $10 million. Let's say we were able to carve out $1.2 million of that basis into 5-year property, $50,000 into 7-year property, and $900,000 into 15-year property. So because the property was acquired and placed in service after the enactment of the Tax Cuts and Jobs Act, which was the most recent tax reform bill, I guess pre-CARES Act, the assets with lives of 20 years or less are eligible to receive 100% bonus depreciation, which provides an immediate depreciation deduction. More on that in the next slide. The blue column reflects the total annual deductions with the study. The green column reflects the total annual deductions without the study. And then the far right section of the chart reflects the increase in deductions and just the overall benefits of the cost segregation study. So in this example, the total additional deductions in 2019 due to the study would yield around $2.1 million in that 2019 tax year. And the overall net present value of the study, and this would be assuming a 7% NPV factor, would be approximately $520,000, which is the box in the bottom right corner of this chart. So let's talk a little bit about the history behind bonus depreciation. So it was first introduced in 2001, and over a 15-year time period, there were varying levels of bonus depreciation, 30%, 50%, 100%, or maybe even none at all. And basically with bonus depreciation, for assets that have tax depreciation lives of 20 years or less from a general depreciation system perspective, those assets are eligible for 100% bonus depreciation. The PATH Act brought changes that would have made bonus depreciation 50% in 2016, 2017, and then it was going to be phased down slightly for 2 years and completely phased out by 2020. The current law under the Tax Cuts and Jobs Act, the tax reform package previous to the CARES Act, it provided changes to bonus depreciation that could last nearly a decade. So the change was retroactive to qualified property placed in service after September 27, 2017. It not only increased bonus from 50% to 100%, but the property eligible for bonus depreciation was expanded to include used property. And so that previous example that we saw on the last slide with the $10 million office building acquisition in 2019, we were able to take bonus depreciation on those assets, even though they had been in service by another taxpayer previously. And with the Tax Cuts and Jobs Act, the bonus depreciation percentage phases down by 20% per year, starting in 2023, and then it's completely phased out by 2027. So bottom line, bonus depreciation is a very powerful tool and it can really enhance the benefits of a cost segregation study. So the next cash flow strategy we're going to talk about is qualified improvement property, both before and after the CARES Act. But first, let's talk a little bit about the history of just improvement property as a whole and how we got where we are today. So prior to 2001, improvements were depreciated using the standard building depreciable lives of 39 years or 40 years for ADS, so there were no special tax incentives. In 2001, qualified leasehold improvement property was introduced at the same time as bonus depreciation. And we call, qualified leasehold improvement property, we'll call it QLIP from here on out in this webcast. So QLIP improvements were recovered over 39 years, but they were eligible for bonus depreciation. So these were generally interior non-structural improvements to non-residential buildings. But it was also fairly restrictive in that the improvements had to have been made 3 years after the building was first placed in service. Plus, the improvements had to have been made pursuant to a lease between unrelated parties. So in 2004, QLIP was moved from 39 to 15 years, and again, it was still eligible for bonus. And also, two new categories were introduced: qualified restaurant property, QRP, and qualified retail improvement property, QRIP, both with 15-year lives. So over the course of the next decade, there weren't many changes to improvement property, with the exception of the definition of qualified restaurant property changing slightly. So that is until we got to the PATH Act, which went into effect on January 1st of 2016. This is when qualified improvement property was first introduced with a 39-year life, and it was eligible for bonus depreciation. The notable difference between QIP and QLIP is that there was no 3-year rule with QIP, nor were there related party lease rules. So this meant that industries that previously couldn't take advantage of improvement property were now eligible under QIP. So this would be in industries where maybe no lease exists, like in hotels, or leases that typically would have been between unrelated, or typically would have been between related parties, so such as auto dealerships, manufacturing facilities, medical office buildings, so on and so forth. The QIP was so all-encompassing that Congress wanted to actually simplify improvement property altogether. And their vehicle for doing this was through the Tax Cuts and Jobs Act that I've mentioned a couple of times. So they set out to do two things. First, Congress wanted to eliminate the separate definitions of improvement property, so getting rid of QLIP, QRP, and QRIP. So there was only the simpler version, QIP, in the tax law. And second, Congress intended to move QIP to a 15-year life, still eligible for bonus depreciation, and the ADS life to 20 years, not eligible for bonus. So while Congress was able to achieve the first goal of eliminating the three separate definitions of qualified property, they failed to actually make the proper changes to the actual statute about the QIP life. So bottom line is that we were stuck with the 39-year recovery period and no bonus depreciation for qualified improvement property until such a time that a technical correction was made to the statute. So before we get into the recent changes to QIP, let's first discuss what it is. So basically, it's any improvement made by a taxpayer to an interior portion of a building, which is non-residential real property. So these improvements have to be placed in service after the date the building itself was placed in service. So you'll notice that there was, again, no 3-year rule. Certain improvements are excluded from the definition of QIP. So this would include, any costs related to enlarging the building. So maybe you do an expansion off the side of a building, or going vertical and adding a floor. Elevators and escalators are excluded. And then lastly, internal structural framework, any work done to that in the building, that would be excluded as well. So, in that case, it'd be seismic retrofits to building beams or foundations, or maybe floor structure changes. And then, of course, because the work has to be done to the interior of the building, any exterior work is excluded from the definition of QIP. So that would include exterior windows, doors, exterior paint, rooftop HVAC units, exterior lighting, etc. And also worth noting, other improvements not eligible for QIP would include newly constructed buildings because, again, there has to be at least some time that it's passed since the building was first placed in service. And then also not qualifying for QIP would be improvements in acquired buildings or acquired leasehold improvements. And this would be just because the taxpayer acquiring the assets would need to have been the one who made the improvements in order to qualify for QIP. So the CARES Act provided the technical correction to QIP that taxpayers have been anxiously waiting for. And like I said, this is significant for taxpayers across all industries. The technical correction, which is retroactive to January 1st of 2018, changes the recovery period for QIP from 39 to 15 years, which also makes it eligible for the additional first-year bonus depreciation allowance under the Tax Cuts and Jobs Act. And then under the alternative depreciation system, ADS, QIP is now recovered over 20 years as opposed previously to 40 years, although ADS assets are still not eligible for bonus depreciation. And lastly, the CARES Act added a language made by the taxpayer to the definition of QIP. And this was to clear up any confusion about improvements that had been made by others, as I mentioned previously, as it relates to acquired assets. So if a taxpayer acquires a building with existing improvements, those improvements are not eligible for QIP treatment. Instead, a cost segregation study could be completed to extract the personal property within the existing improvements. So why is this such a big deal? Now that QIP is eligible for a 15-year life and bonus depreciation, it provides a significant tax planning opportunity. During a time of economic uncertainty like we're experiencing right now, cash, of course, is king. And QIP is a great way to generate immediate cash to taxpayers during a time when they need it the most. QIP can be especially powerful when coupled with the net operating loss carryback opportunity from the CARES Act, because taxpayers may be able to generate permanent tax savings by utilizing the tax rate arbitrage from the lower federal tax rates prior to the Tax Cuts and Jobs Act. Jarrid's going to talk more about this in depth later in the webcast. So here's just a quick example to show how significant the QIP change is. So assume $5 million of QIP placed in service in July of 2018. And of course, it would be eligible for 100% bonus if applicable. Prior to the CARES Act, there was very little difference for GDS and ADS depreciation because they have 39 and 40-year recovery periods with no bonus. So it's nearly $60,000 in depreciation in both cases. But after the CARES Act, the differences are significant. With the GDS life of QIP at 15 years with 100% bonus, that entire $5 million can be deducted immediately. After the CARES Act, the ADS depreciation, of course, would also increase, but on a much smaller scale since it's not eligible for bonus. So the reason I bring this up is it speaks to the importance of prior 163J elections. And if a taxpayer elected out of the interest limitation and did not actually revoke that election per recent revenue procedures, then QIP would continue to have a 20-year ADS life with no bonus depreciation eligibility. And then if a taxpayer did not elect out of the interest limitation, then QIP would have the 15-year GDS life and, they'd be able to reap that $5 million benefit in this example. All right, so I think we're at the next polling question.
Yeah, so the question is, has your company taken advantage of the recent retroactive change to qualified improvement property in the CARES Act? Option A is yes, option B is no, and option C is not sure. We'll give about 30 seconds to let everybody answer. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We'll also be sending the slides in email after the webcast. Okay, 80% have answered. Give it a few more seconds here. Okay, back to you, Kyle.
Yeah, so this is kind of, again, similar to the first polling question, kind of across the spectrum and to be expected. So, the majority of you have said no, which, for a lot of companies, just the timing of the CARES Act was, it came in late March, and, we had these changes that were significant, and maybe a lot of taxpayers had already filed 2019 returns at that point. And, there are opportunities to go back in time that Jarrid's going to talk about on some later slides. But, for a lot of taxpayers, they may have already filed 2019 returns and not able to, to make the change to QIP on their 2019 return, and instead would be looking at 2020. So, yeah, these results are not that surprising. So the next strategy we're going to talk about is energy efficient incentives. And in December of 2019, which seems like a lifetime ago at this point, President Trump signed an extender's tax package into law, which extended a number of provisions that had previously expired at the end of 2017. Two of these provisions were energy efficient incentives. So the Section 179D deduction and the Section 45L credit. So I'm going to start with the Section 179D energy efficient commercial building deduction, which is available for newly constructed commercial buildings or building improvements. So this deduction is available for improvements placed in service between January 1st, 2006 and December 31st, 2020. So there's now a 15-year window. And one of the great aspects about this deduction is it can also be done on a look-back basis through an automatic accounting method change, Form 3115, similar to what we mentioned for cost segregation studies and for the QIP change. So both building owners and designers can claim the deduction. More specifically, these categories include the owners and tenants of commercial properties, but only if they've built or actually installed the improvements. And also, residential buildings would qualify for the deduction if they are 4 stories or greater. And for designers such as architects, engineers, or contractors, they must have designed government-owned energy-efficient buildings in order to get the deduction themselves. So this deduction can be as much as $1.80 per square foot for commercial building efficiency improvements. They have to be above certain thresholds for energy efficiency for 3 distinct categories, with each of these receiving up to 60 cents per square foot. So the 3 categories are listed here. It's HVAC systems, interior lighting projects, then building envelopes. And the building envelope would just be looking at things like the type of windows or the rating of the insulation that was installed, things like that. So let's say you had a 100,000 square foot building and you qualify for all 3 deductions at $1.80 per square foot. Your total Section 179D deduction would be $180,000. So pretty simple calculation. Taxpayers can also claim the deduction for just 1 or 2 of the per square foot deductions, depending on the type of work completed. So for instance, if you just had an interior lighting project only, you could receive 60 cents per square foot just for that project alone. In order to get the deduction, a contractor or professional engineer licensed in the state where the building is physically located must model the energy performance of the building, and then it has to be compared to the standards set by ASHRAE. A common misconception, too, is that LEED certification automatically means that you'll be able to take the full $1.80 per square foot deduction. Although it's definitely helpful to determine likelihood of qualification, the energy modeling project is still a requirement. So the other energy efficient incentive that was in the extenders package was the Section 45L energy efficient home credit. This credit's $2,000 per dwelling unit, and it applies to either newly constructed buildings or substantial improvement projects. Of course, if they meet the energy efficient standards outlined in Section 45L. Similar to 179D, the certification for energy efficiency under 45L must be completed by a qualified third party. And also similar to 179D, the 45L credit is available for developers who had improvements placed in service between January 1st, 2006 and December 31st, 2020. So again, there's a 15-year window, but the difference with Section 179D is that you can only claim the 45L credit in prior tax years by amending tax returns. So it's a bit more of an administrative burden to get the credit on a look-back basis, but if you're only a few years removed from that property being placed in service, it's definitely something worth looking at. So all types of residential properties would qualify if they are 3 stories or less, and that would include, that would not include below-grade parking. So as an example, let's assume a taxpayer constructs a garden-style apartment complex or maybe a senior housing facility, and all the buildings on the property are 3 stories or less. If there's 100 total units in the apartment complex or the senior housing facility, the taxpayer qualifies or hires a qualified third party to actually certify the energy efficiency of the buildings, and that $45 credit would be $200,000. The 100 total units in the facility, whether it's apartment or senior housing, doesn't matter. The 100 total units multiplied by the $2,000 credit per dwelling unit, gets you that $45 credit of $200,000. The property types are really, again, it's any type of residential property. So I've listed a couple here, but, they even include mobile home parks and, anything, I think even, manufactured homes, things like that would kind of fit into this category as well, assuming that they're energy efficient. So now we're going to get into another polling question.
Yeah, so the question is, if a taxpayer constructs a 5-story apartment building, the taxpayer is able to receive which energy efficient tax incentives? A is Section 179D, B is Section 45L, C is both A and B, and D is none of the above. And just to let you know, once you've completed all the polling questions and CPE requirements today, you'll be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. We're going to give a little more time for people to answer. Only got 75% so far, so make sure you get your answers here. Give it a few more seconds. Okay, and back to you, Kyle.
Yeah, so with the results here, the most common answer was C. About half of you answered C, which is both A and B. And I know this polling question came kind of fast and furious after the last couple of slides, but in this case, it's basically you're able to get one or the other, so there's not going to be really much cross-reference with 179D or 45L. In this case, with the 5-story apartment building, any housing facility that has that has 3 stories or less would qualify for the Section 45L home credit. And then any apartment building or housing, type building that's 4 stories or more would have to revert to the Section 179D deduction. So that was actually the second most picked selection. And, again, I think these, the last couple slides, you may want to take a look through and to see if any of those apply to your business and if you can utilize either of those energy efficient incentives. And I think I'm going to pass it off to Jarrid now to talk about fixed asset studies.
Yeah, thank you, Kyle. So another great strategy to be aware of is what we call the fixed asset study. They're also commonly referred to as fixed asset reviews or fixed asset scrubs. But essentially what it entails is a very comprehensive, detailed review of the company's fixed asset holdings in order to identify a whole series of cost recovery issues and ultimately propose cost recovery changes that will help to accelerate and catch up on tax deductions and losses that the company's entitled to with respect to those fixed asset holdings. So a quality study will entail a professional, hopefully with some form of a cost segregation or real estate background, really getting to know your business, the nature of the business operations, where your business operations are physically located, how they're conducted, and just kind of the history of capital expenditures and projects that you've conducted to keep your business operating. So much of the statutory guidance for asset classifications and cost recovery is based off of that. So having that contextual background from the starting point will help to really identify exposure areas, risk areas, opportunities for changing cost recovery methods and getting to where we should be with respect to those losses and deductions. These studies are most useful for companies with high volume material fixed asset holdings, generally $25 million or more in total fixed assets. However, they provide really exceptional value to those companies in the retail and restaurant industries, as well as manufacturers, food producers, contractors, and so forth. And the reason for that is that if you think about the retail and restaurant companies, they're constantly doing remodel projects to open new locations or to refresh existing spaces. And manufacturers, contractors, food producers, they're always engaging in large capital projects to replace heavy machinery and equipment and to modify their existing facilities as needed for specific production processes. Now, at face value, a lot of these projects could appear to be building improvements, and they're often erroneously depreciated over 39 years as building improvements for tax purposes, often overlooking more accelerated recovery periods by classifying a lot of those project costs as shorter 5 or 7 year personal property. So again, the real value is having a professional take an objective look with a good understanding of your business and being able to identify costs that are more business related rather than facility related there, and go ahead and help you accelerate losses and deductions in those areas. Important to note here that you could go back as far as it makes sense to, as long as we still have assets being depreciated actively on the books. Makes sense to go back and revisit the cost recovery methods currently being used for those items. I mentioned the specific industries there, but also going back a little broader, it could also provide great value for those companies that self-manage the tax reporting process for fixed assets in-house. We often find that the tax accounting methods and reporting kind of takes a backseat to book reporting. Maybe for book you're using GAAP or Medicare or some other set of guidelines for classifying and depreciating assets, and that doesn't always cleanly translate to tax accounting methods, and as a result there could be some missed opportunities for accelerated depreciation and write-offs there. So an issue that we commonly come across with these studies is when less than the allowable amount of depreciation has been claimed for an asset or group of assets, commonly caused by companies not claiming bonus depreciation or making 179 elections when they were entitled to. The laws around bonus have constantly been changing since the early 2000s, both in the applicable rate to be applied and what property it applies to, so it's understandable that this is missed sometimes. Wrong recovery periods, again, as I kind of alluded to, we might have 5 or 7 year personal property being recovered as 39-year building property. We also see missed opportunities for asset classifications, especially in the improvement property classifications. Kyle talked in great detail about the prior retail improvement property, restaurant improvement property classifications, generally allowing for that 15-year recovery period. Not uncommon to find restaurants and retailers that are depreciating their leasehold project assets over 39 years when this more accelerated favorable method is available to them. We also consult, a big part of these studies is consulting on construction in progress suspense accounts and helping companies pull forward costs related to project assets that have actually been placed into service. This happens a lot with our manufacturers and food producers that do a lot of large phase capital projects to their facilities, maybe a 4-phase plan to improve 4 different sections of the buildings, and we find that the first 2 phases, first 2 areas have been completed with people working in them for 5 years, but yet the underlying costs are still in a non-depreciable CIP account just because the ultimate 4th phase has not been completed yet. We help kind of true that up and catch up there where needed. So I went ahead and noted some examples here from recent fixed asset studies that we did for a couple of our clients. And I know I mentioned the restaurant and retailers a couple of times, but maybe worth noting is the healthcare client at the bottom. They're always making heavy investments in equipment, lots of imaging and radiology type equipment that is a very big ordeal to install. They're generally having to relocate or remove walls and plumbing and electrical fixtures. And again, at a first glance, that could appear to be a building improvement, and that's exactly how they have been depreciating the costs as 39-year building improvements. We were able to reclassify a very material portion of those costs as 5-year property and get them a $5 million depreciation adjustment of additional depreciation there. Another issue that we commonly encounter is late disposals. We casually refer to it as ghost assets, but it's essentially where we have the cost of an asset still being depreciated, where the asset was physically removed or disposed of in a prior year. This is really prevalent for companies operating out of multiple physical locations where their assets are tracked by the physical location. So what we might find is, for a retailer, they've replaced the same HVAC unit 3 times at a specific location, but because it's not tracked per that location, the first 2 iterations of that HVAC unit or other machinery and equipment are still on the books being depreciated. So what we're able to do on the current year tax return is go ahead and claim a disposal loss for the net tax value of any of those assets that are hanging out there that were disposed. There's no need to go back and amend. We're able to just file a method change to kind of catch up to where we should be with respect to our disposals. Also put down another example of a different healthcare client that owns a collection of medical office buildings, and on their current year return, we had noticed a very material remodel to an entire floor in 2015 to where they had taken the finished space back down to the studs. And by looking at the history of that building and the remodels over time, we had found earlier remodels in the 2005 that would have likely been disposed of by reason of the 2015 remodel. So we're able again there to claim a disposal loss with the current year tax return. So we also like to remind people of the tangible property regulations that came out about 6 years ago now, just ahead of the 2014 tax filing season. The regulations provided guidance for expenditures to existing tangible property and provided a whole framework as well as a series of safe harbors to aid in determining whether costs should be treated as capital improvements and depreciated, or if they could be expensed as deductible repair and maintenance items. A lot of companies took steps and filed accounting method change requests with their 2014 tax returns in order to adopt the rules under the regulations and get on those new methods for that framework guidance. But what we've been finding in the process generally of doing fixed asset reviews and scrubs is that many companies are still capitalizing and depreciating costs associated with deductible repair and maintenance expenses. And this is really prevalent for companies with dense real estate fixed asset holdings. If you think about all of the upkeep and maintenance activities, as well as the elective remodel type activities that are required to keep a building operating efficiently, it could become challenging to keep up with that and apply the framework guidance. The other issue that comes up is that framework guidance in the regulations requires us to really look beyond the cost of an activity and really consider how specific projects impacted very specific units of property or components of a building. And as accountants, that could be challenging for us sometimes to understand a specific plumbing system or HVAC system and how a project is really impacting that. So as a result, unfortunately, we do see some of those deductible repair and maintenance items capitalized and depreciated over 39 years. The good thing is that there is a solution of doing a repair study. You should be able to consult with a professional, hopefully one, again, that has cost segregation or some form of real estate experience to help you apply that framework guidance under the regulations, especially for those years to where you have material fixed asset activity or capital projects related to your real estate holdings. Also important to note that we could go ahead and kind of claw back into prior years, not just limited to current year, but we could also go back and look at any assets placed in service in prior tax years that might be deductible repair and maintenance expenditures and go ahead and write off the net tax basis on our current year tax return to catch up on those repair and maintenance expenditures. That's done again with an automatic accounting method change request. Aside from catching up to where we should be on those deductible repair and maintenance items, another big benefit we find is that companies who go through the process of a repair study with respect to their current year additions or maybe a very comprehensive historical look, they come out of the process a lot more familiar with the framework guidance and rules under the tangible property regulations. They're generally familiar with the types of activities that recurring activities that could be expensed versus what items are capital improvements, and they're able to stay ahead of that on a go-forward basis. So this brings us to our next polling question.
All right, so we've got a true or false question here. In order to claim a deduction for over-capitalized repair expenses from a prior year, a taxpayer must amend their tax returns. A, true, or B, false? And this is our last polling question of the webcast. Just as a reminder, to get to your CPE credit, you have to attend at least 50 minutes of the webcast and answer at least 3 of our polling questions. And we'll give this a little more time, a little shorter to answer here. We've got about 70% who have answered. Let's give it 10 more seconds, folks. All right, Jarrid, I'm going to pass it over to you. And Jarrid, can't hear you. It might be on mute still.
So it looks like most people answered B, false, which is correct. The IRS allows us to file automatic accounting method change requests, which we'll cover in more detail here in a little bit. But it's essentially a streamlined reporting process based on repairs and maintenance being a statutory change there. We're able to file accounting method changes on our current year tax returns without going back and opening up any prior tax years. So wanted to briefly touch on the net operating loss carryback opportunity. Many of you are aware that the CARES Act restored the 5-year net operating loss carryback for any losses arising between the 2017 and 2020 tax years there. So the real big takeaway here, especially for those companies structured as C corporations, is if you're already going through the motions and procedures or thinking about doing an NOL carryback, do give considerations to your existing fixed asset holdings and which of these strategies you may be able to apply that Kyle and I have been talking about. Any additional losses that we could stack on top of those and capture at those higher tax rates that were generally available in prior years will create real bottom line savings with that permanent tax difference. As an example, we just consulted with a food processing company that was thinking about carrying back a 2018 loss, and we're talking to them about doing a fixed asset study. And through the process of that, we were able to find them an additional $2 million of repair and maintenance deductions, additional depreciation deductions there, which got monetized into a $700,000 tax savings benefit there at that higher 35% rate and carrying that back. So just something to be mindful of if you're going through the motions there already with the NOL carrybacks. We also wanted to discuss the procedures and steps to take for implementing the cost recovery change results from one of these strategies that you might engage in. It's important to remember that anytime we're applying one of these strategies to assets placed in service during a prior tax year, we're technically changing the accounting method, the tax accounting method for those items. And we have to do two things. We have to report the proposed changes to the IRS along with a monetary numerical adjustment that kind of reflects where we would have been from a net tax position had we always been applying those proposed changes that came out of the fixed asset study or other fixed asset strategy there. Luckily, the IRS allows us to do what's called an automatic accounting method change request on a Form 3115. It's a very streamlined reporting process that allows us to essentially file that form with our current year tax return. There's no need to go back and amend any prior year tax returns to report many of these changes that Kyle and I have been talking about today. The rationale there being is the IRS acknowledges that many of these cost recovery methods and provisions, they've been available. There's sufficient legal basis to support those without more of a private letter ruling specific request approach. So they allow us to do these, what I call them canned changes on automatic filing forms to go ahead and report kind of how we were accounting for the assets prior to the changes and how we're proposing to treat them now, along with that numerical adjustment. So a great example is if you went ahead and did a cost segregation study related to an office building that you purchased and placed in service in 2015, and you've only claimed $1 million of depreciation since 2015. But in the cost segregation study, we find that you could have claimed $5 million. The process there for tying that into your 2019 return would just be filing a Form 3115 and explaining all of the assets identified from the cost segregation study and how we're going to be accounting for those, and then including a $4 million adjustment to depreciation expense on the 19 return to get us up to that total cumulative $5 million depreciation amount there. You are able to, the one exception to this is you are able to amend for any of these changes for assets placed in service in the immediate preceding tax year. So we're applying any of these strategies or changes to assets placed in service in 2018. We are able to amend, and that may make sense depending on other changes we're making, especially changes out of the CARES Act. If we're making changes for 163J elections, NOL carrybacks, may make more sense to do that. And going off of that as well, the CARES Act changes, one of the hottest topics being the qualified improvement property cost recovery change that Kyle spoke to. They do specifically mention that could be handled on an amended 2018 return or a Form 3115 with your 2019 or 2020 tax return. Again, depending on what makes sense based off your business structure and overall tax situation there. Kyle, I'll pass it back to you.
Yeah, thanks, Jarrid. So just some of the key takeaways here, just kind of going back through the presentation. Obviously, Jarrid just got done talking about, some of the implementation changes for QIP, and, because it's been corrected, and it was a retroactive change at the beginning of 2018, this is a significant opportunity for really any assets that are placed in service since that date. And again, QIP has been around since 2016. So in a lot of cases, it makes sense, if you are kind of in that industry that wouldn't have, been able to benefit from improvement property previously, it might make sense to look back at assets placed in service all the way back to 2016 even. And we mentioned bonus depreciation throughout this presentation. Now that it's 100%, it's just a huge opportunity for capital expenditures that actually qualify for bonus depreciation, and that would be again with when utilized with the cost segregation study. Then we talked about those two energy efficient incentives, the Section 179D with the commercial building deduction, and then 45L, which would be more on the residential side. They're both back. They're both still around through the end of this year, at least, until we get potentially another extenders package that the Congress passes and the president's able to sign. And then Jarrid just talked about overcapitalized repairs and fixed asset studies, and they both just provide a really significant opportunity for taxpayers that have a lot of fixed assets. You can go back in time and catch up all that depreciation that you could have taken, or in some cases on the overcapitalized repairs, you get that immediate expense. And there's different avenues to get those those benefits, whether it's from 3115s or in some cases by amending depending on the year. And so you want to make sure that you talk to your tax provider to make sure you're planning for all of that. Dustin, I think, should we move on to just a quick Q&A since we have about 2 minutes here?
Yeah, we have a few questions for you guys. So the first question would be, would the installation of roof solar panels qualify as energy efficient?
Yeah, so that's a good question and one we get pretty often. So roof solar panels are considered energy property. So this is kind of a side topic from this presentation. It really doesn't have any bearing on Section 179D or Section 45L. And those solar panels would just be treated with it's a energy property, which is a 5-year life. So it's accelerated. It's on an accelerated method, which is good, and it provides great tax incentives if you're installing those on your roof or somewhere else on your property.
All right, and then the other question is, if you have a building that started construction in the summer of 2017, but it was placed in service in 2018, what bonus depreciation percentage would you be able to receive?
Yeah, so this is something that we're still seeing a lot of because, again, with cost segregation studies, we can go back in time and look at that. And one of the things that we're always trying to confirm is, when the contract to actually build the property or build the facility was, considered binding. And the definition of that is, as defined by the IRS, it's a written binding contract. It has to be enforceable under state law. And so if you started construction on a building with a written binding contract prior to that September 27th date of 2017, then you would revert back to the pre-Tax Cuts and Jobs Act bonus percentage. So in this case, even though you're placing it in service in 2018, in a 100% bonus depreciation year, you would only be able to get 40% bonus on those assets, that are carved out from the cost segregation study. And I think we're getting up here to 60 minutes, so I'll pass it off to you, Dustin.
All right. Well, thank you, Kyle and Jarrid, for the great presentation today. If we didn't have time to answer questions that came into the chat box, we'll do our best to follow up with everyone after the webcast. And as a few reminders here, if you attended today's presentation in a group and would like to receive CPE credit, you have to complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and you met all the certification requirements, your certificate is available to download in the CPE progress window to the right of the slide view. I'll keep this webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your certificate will be emailed to you within about 3 weeks in case you have any difficulty downloading it. And on your screen, you should see a link to an online survey where you can provide feedback for our presentation today. Please take a moment to complete this survey as your feedback is extremely important to us. And with that, thanks again, Kyle and Jarrid, and thank everyone for joining us. We hope you'll join us again next time.